Welcome to the big financial fight to find the best spot for your hard cash. Today, we analyze three big rivals: single stocks, mixed index funds, and wild crypto coins. The money world is loud, often making new folks feel lost, stuck, and very scared. Our aim in this full guide is to stop the noise and give you clear help. We will name each type, look at the past, and fairly judge the good and bad. By the end, you will surely know which path fits your own money goals the best. You must note there is no single best pick. The right choice rests totally on you. We need to build a firm base of facts before we can compare risks and gains. So let us get ready to see how cash truly grows inside these big markets now. We start with the oldest and best-known type: buying shares of single company stocks today. So, what is a stock? It's just a small piece of a real working business. When you buy a stock, you own a part and share in its wins or losses. Buying stocks means you bet on the smarts and profits of one specific team of bosses. The main way you earn cash is price growth, which means the stock value goes up. The next way is dividends, or regular cash payouts sent from profits right to your hand. The big draw of single stocks is the chance for huge gains if you pick winners. Think of buying Amazon in the old days, or Apple shares before the new phone came. Yet this chance for high reward brings a huge risk of total and lasting loss too. If that one firm goes broke, your whole stake in that stock can drop to zero. Picking winning stocks all the time for many years is very hard, even for the pros. It takes much time reading reports, knowing firm edges, and watching market trends day by day.
It requires significant time researching financial statements, understanding competitive advantages, and monitoring market trends constantly. Many beginners make emotional decisions, buying high due to FOMO and selling low due to panic. The key takeaway for individual stocks is that they offer high growth potential but require high efforts and carry high risk. Now let us pivot to the second contender, which was designed specifically to solve the problems of stock picking. Introducing the index fund, often hailed by experts as the most sensible investment for the average person. Instead of trying to pick the single best needle in the haystack, an index fund simply buys the entire haystack. An index fund is a pre-packaged basket that holds hundreds or even thousands of different individual stocks at once. The most famous example is an S&P 500 index fund, which tracks the 500 largest companies in America. By buying one single share of this fund, you instantly own a tiny slice of all 500 companies. This introduces the powerful concept of diversification, which is essential for managing risk in your portfolio. If one company in the index goes bankrupt, it is merely a small dent that is offset by the others. You are no longer betting on a single horse, you are betting on the entire track circuit to succeed over time. Index funds are considered passive investing because there is no expensive fund manager actively trying to outsmart the market. Because they are passive, they have extremely low fees, meaning more of your money stays invested and compounding for you. Historically, broad market index funds have provided solid, reliable returns over long periods, despite short-term volatility. The main con is that you will never achieve massive overnight gains like you might with a lucky stock pick. Your returns will always be the average of the market, which fortunately is usually quite good over decades. Index funds are the slow and steady wins the race approach, requiring patience, discipline, and a long-term mindset. They are perfect for beginners who want to build wealth without spending hours analyzing charts every single day. Now prepare yourselves for the third and final contender, the Wild West of the modern financial landscape. Enter cryptocurrency, digital assets that are not controlled by any central bank, government, or financial institution. Crypto relies on revolutionary technology called the blockchain, which is essentially a decentralized public digital ledger. The most famous examples are Bitcoin, often called digital gold, and Ethereum, a platform for decentralized applications. Unlike stocks, buying crypto does not give you ownership of a company or a claim on its future profits. The value of most crypto is driven almost entirely by supply and demand, market sentiment, and pure speculation. This asset class is defined by extreme volatility, with prices often swinging wildly by double digits in a single day. The potential allure is life-changing wealth in a very short time frame, which has attracted millions of young investors. However, the risks are utterly massive, including total value loss, exchange hacks, scams, and complex security requirements. Crypto is best viewed not as an investment, but as a high-risk speculative bet on the future of technology. So, we have defined our contenders. Now, let us directly compare them based on the most critical factor, risk. On a spectrum of risk, index funds sit securely on the lower end due to their inherent diversification. While the entire market can crash, it is highly improbable that all 500 companies will go bankrupt simultaneously. Individual stocks sit squarely in the middle of the risk spectrum, varying wildly based on the specific company. A well-established, profitable blue-chip company is far less risky than a brand-new, unproven startup company. Cryptocurrency occupies the extreme high end of the risk spectrum, often behaving more like gambling than investing. The potential of losing 50 to 80% of your money in a crypto bear market is exceedingly real. Next, let us compare the time commitment and effort required to manage each of these investments successfully. Index funds are the ultimate set-it-and-forget-it investment, requiring almost zero ongoing effort or maintenance. You can automate monthly contributions and literally go enjoy your life while your wealth builds in the background.
Individual stocks, conversely, are a high-maintenance relationship requiring constant attention to news, earnings reports, and industry shifts. Crypto requires perhaps the most intense effort as the market runs 24/7 and news breaks literally every second. Furthermore, the security effort for crypto is massive, involving hardware wallets, seed phrases, and avoiding constant scams. Before we move to the final verdict, we must address some very common myths that confuse beginners. Myth number 1 is that you need a lot of money to start investing in any of these. The truth is that thanks to fractional shares, you can start investing with as little as $1 or $5. Myth number 2 is that investing is a quick way to get rich and buy a Lamborghini next month. Real investing is a slow, boring process of building wealth over many years through discipline and compounding interest. Myth number 3 is that you must perfectly time the market, buying at the exact bottom and selling at the top. Data consistently shows that time in the market beats timing the market for the vast majority of investors. Now let us discuss the historical context of returns to set some realistic expectations for your financial journey. Over the last century, the S&P 500 index has returned an average of roughly 10% per year. This is not a guarantee for any single year, but a long-term historical average that includes many crashes. Individual stock returns are impossible to average because the range is from thousands of percent gains to total zero. Crypto has had a much shorter history, often showing astronomical gains, followed by brutal, extended crypto winters. It is vital to understand that past performance in any of these asset classes is never a guarantee of future results. Now let us move to a practical, step-by-step example of how a beginner actually starts with each of these. To buy stocks or index funds, step 1 is opening a brokerage account with a reputable financial firm. Step 2 is linking your bank account and transferring the money you wish to invest into the brokerage. Step 3 for stocks is searching for the specific company ticker symbol and entering a buy order. Step 3 for index funds is searching for the fund symbol like VOO or SPY and entering your buy order. To buy crypto, step 1 is signing up for a centralized cryptocurrency exchange like Coinbase or Binance. Step 2 involves highly rigorous identity verification, often requiring photos of your driver's license and face. Step 3 is funding the account with fiat currency and exchanging it for your chosen cryptocurrency like Bitcoin. An optional but highly recommended step 4 for crypto is moving your assets off the exchange into a private wallet. Now that we understand the mechanics, let us discuss the psychological aspect of holding these investments during tough times. This is often called the sleep at night factor, and it is much more important than most beginners realize. With index funds, when the market crashes, you can sleep relatively well knowing the whole world isn't ending. With individual stocks, a crash can cause severe anxiety as you wonder if your specific company will ever recover. With crypto, the volatility is so extreme that many investors check their phones obsessively throughout the entire night. Another critical factor to consider is tax efficiency, which can significantly eat into your investment returns over time. Broad market index funds are generally very tax efficient because they do not frequently buy and sell the underlying stocks. Actively trading individual stocks or crypto triggers taxable events constantly, creating a complicated and expensive tax situation. Now let us summarize the ideal investor profile for each of these 3 distinct asset classes. Index funds are the clear winner for 95% of people who want long-term wealth with minimal effort and stress.
They are the foundation of a healthy financial plan, perfect for retirement accounts like IRAs and 401ks. Individual stocks are for those who genuinely enjoy financial research and want to try beating the market average. They are best used for a smaller fun money portion of your portfolio, not your entire life savings. Crypto is for those with an extremely high tolerance for risk who want a speculative bet on future tech. Crypto should only ever be money that you are completely and totally prepared to lose forever tomorrow.
A very popular strategy recommended by many financial advisors is called the Core and Explore method. In this strategy, you build the massive core of your portfolio using boring, diversified, low-cost index funds. This ensures your long-term financial goals, like retirement, are secure on a stable, proven foundation. Then, you use a small percentage, perhaps 5 to 10%, to explore riskier assets like stocks or crypto. This allows you to scratch that itch for excitement and potential high returns without jeopardizing your entire future. Before we conclude, let us briefly touch on the concept of time horizon, as it is absolutely critical here. If you need your money in the next 3 to 5 years, none of these assets are safe places for it. The stock and crypto markets can drop significantly and take years to recover to their previous highs. Money needed for a down payment or a wedding soon should be kept in a high-yield savings account. Investing in stocks, index funds, or crypto should always be viewed as a long-term commitment of at least a decade. Let us reinforce the importance of fees once more, as they are the silent killer of investment returns. In the world of index funds, you must look for the expense ratio, which should be ideally under 0.10%. Paying a 1% fee might sound small, but it can cost you tens of thousands of dollars over decades. For stocks and crypto, the fees are often in the form of trading commissions and spreads on every transaction. Frequent trading in these assets racks up fees quickly, enriching the brokers instead of enriching your own portfolio. We also need to discuss the emotional discipline required to stick to your chosen strategy when things get tough. The hardest part of investing is not the math. It is managing your own psychology when markets are crashing. When prices are plummeting, your instinct will be to panic sell, which is the exact opposite of what you should do. Successful investors stay the course, and many even view crashes as discounts to buy more high-quality assets cheaply. Developing this contrarian mindset takes time and experience, but it is absolutely essential for long-term wealth building. Let us do a final recap of the pros and cons of each contender before you make your decision. Index funds. Pros are instant diversification, low fees, low effort, and proven historical performance. Index funds. Cons are that you will only ever get average market returns and never beat the market. Individual stocks. Pros are the potential for massive uncapped gains and the excitement of ownership. Individual stocks. Cons are high risk of loss, high effort required for research, and emotional stress. Crypto. Pros are the potential for life-changing wealth in short time frames and access to new technology. Cons are extreme volatility, risk of total loss, complex security, and lack of regulation. As we near the end, I want to leave you with 3 golden rules for beginner investors. Golden rule number 1. Never ever invest money that you cannot afford to lose completely. Ensure you have an emergency fund covering 3 to 6 months of expenses before investing a single dime. Golden rule number 2. Consistency is far more important than the amount of money you invest. Investing $50 every single month is better than investing $1,000 once and never again. Set up automatic contributions so you do not have to think about it or rely on willpower. Golden rule number 3. Keep learning, but do not let information overload paralyze you from starting. The best way to learn is by doing with small amounts of money that you can afford to lose. You will learn more about your risk tolerance in your first market crash than in any book. Ultimately, the decision between index funds, stocks, and crypto is a personal one based on your goals. If you want the highest probability of long-term success with the least amount of effort, choose index funds. If you crave the excitement of research and the potential to beat the market, dabble in individual stocks. If you have a very high risk tolerance and want to bet on future tech, allocate a small amount to crypto. Remember that you do not have to pick just one. The Core and Explore method is a fantastic balance. The most important thing you can do is simply to get started today, no matter how small the amount. Time is your greatest asset in investing, and every day you wait is a day of lost compounding growth. I hope this ultimate guide has cleared up the confusion and given you the confidence to take that first step.
If you found this deep dive helpful, please consider liking the video and subscribing for more financial education. Drop a comment below letting me know which asset class you are planning to start with and why. Thank you so much for investing your time with me today. I truly appreciate you watching all the way through. Until next time, keep learning, keep investing, and take control of your financial future.